Let's get started. Thanks everyone for coming today. Let me start by thanking everyone at the Kellogg Institute and the Liu Institute for making this visit and seminar possible. And especially I want to thank Therese Hanlon for all the work and care she put into this visit. So thanks again, Therese. Today we have the pleasure of welcoming Professor Sebastian Horn, a leading scholar in international finance and sovereign debt, to deliver our Tuesday lecture. Sebastian has a dual appointment. He's a faculty member in international finance at the University of Hamburg. And since 2024, he leads the newly founded research group, the International Financial System, at the Kiel Institute for the World Economy. After earning his PhD in economics from LMU Munich in 2020, Sebastian spent 3 years as an advisor in the chief economist office at the World Bank. His research spans international finance, sovereign debt, financial crisis, and the global role of emerging market lenders. And in particular, related to today's topic, he's one of the leading scholars in what is one of the major recent developments in international finance, the emergence of China as a prominent lender to developing countries. Last but not least, Sebastian and I have been collaborating on at least 2 projects recently, one on sovereign debt statistics and transparency, the other on financial geopolitical fragmentation. And so we both want to thank the Kellogg Institute for supporting Sebastian's visit and funding our various research ventures in multiple ways. We hope you continue to do so. So please join me again in welcoming Sebastian Horn.
Thank you very much, Cesar, for the kind introduction. Thank you very much for having me, for the kind introduction to travel to Notre Dame. Thank you very much, Therese, for the fantastic organization of my visit. And it's my great pleasure to talk to you today about
Sorry, let me interrupt you. I was meant to say that if you are watching this from Zoom, you are more than welcome to submit questions. There is a box somewhere there to submit your question. And Sebastian is very used to the econ style of seminars, so please interrupt often and frequently. Yes.
Yeah, so very happy to be here to talk about our research on China's overseas lending. As Cesar has said, probably one of the most profound changes in international sovereign debt markets of the past 2 decades. The starting point for my talk today is the observation that China, and by that I mean the Chinese government and all variety of Chinese state-owned entities, have provided record amounts, around $1 trillion by some estimates, we don't even know for sure, in loans to developing countries, to emerging market countries, in order to finance large infrastructure and energy projects. This lending boom has transformed China into the world's largest official creditor, by that I mean state creditor. And now that many developing and emerging market countries are facing that distress, it has also transformed China in a very important player in the international financial architecture, in particular when it comes to the resolution of sovereign debt distress. And this growing footprint of China in the international financial system has created a variety of knowledge gaps. That has two major reasons. One, the Chinese government treats the overseas lending activities of its state-owned enterprises as a state secret. So it has been very difficult for, at least for a very long time, to understand how exactly this overseas lending boom has occurred, how large it is, what the drivers of the lending were. And closely related to that, the academic literature for a very long time has really focused on the international bond market or the US as the world financial center. And there has been comparatively little attention to China's growing activity as a global credit development country. So I want to be very descriptive today. I want to draw up multiple papers that we have written and try to give you a comprehensive overview on how China's overseas lending took place and how it's going to be a core emphasis of the talk, how the different stages of the boom that by now morphed into can be considered a capital flow bust with widespread debt distress in resilient countries. And I want to talk to you about how China has been dealing with this challenge and has been dealing with debt distress. So rather than focusing on one specific paper, I would like to introduce to you this research agenda that I've worked on with a whole variety of co-authors, including Carmen Reinhardt, Christoph Krebesch, Fred Parks, and Gelpern, and also, of course, Cesar, in our work on debt transparency and issue debt. The core point I want to make today is that this capital flow boom bust cycle by Chinese creditors shares many parallels with past capital flow booms and busts in developing countries. So my lecture today will be structured by first talking about the boom years. Again, the drivers, the magnitudes, the recipients, the terms of the loans, and the issue of hidden debt, which has been a core issue in this overseas lending boom. Then in the second part, I'll turn to the bust. I'll talk about rising debt stress levels. Some of you may be aware that developing countries, in particular low-income countries, are experiencing elevated levels of net distress, and that has very fundamentally affected China's Belt and Road Initiative. And in this context, I want to discuss how Chinese creditors have responded to distress. And as Cesar said, let me emphasize, I'm really happy to take your questions as we go. If I'm being unclear, just interrupt and not. Before I dive into China's overseas lending boom, I would like to set the stage by talking a bit about boom-bust cycles in developing countries in general and offering a long-run perspective on debt distress. As I said, I think the core argument of our work is that the current lending boom by China shares many similarities with past boom-bust cycles. And maybe there's a situation in developing countries does so more generally. During the 2010s, developing countries attracted very large capital inflows in an environment of very benign global conditions. Interest rates were at record lows, commodity prices were very high. Low-income countries, developing countries had coped very well with the global financial crisis. So there was widespread optimism. And then starting around 2015, these very favorable global conditions suddenly reversed. Commodity prices crashed. The capital flows to developing countries declined. Later on, US monetary policy reversed. And there was what is sometimes called a double bust. Commodity prices and capital flows decreased after being very accommodative, very supportive for a long time. And historically, this has been a very good predictor of debt distress in developing countries. And you can see that here in this graph where the red line shows you the share of developing countries that enter debt distress over a 200-year sample. You can see that debt distress in developing countries tend to occur in waves, right? You have these spikes, where a very large share of countries enter distress. And then on top of that, you can see the gray areas that indicate exactly these instances where simultaneously commodity prices drop and capital flows to developing countries reverse. You can see, for example, in the 1980s debt crisis, the reversal of global conditions was a major factor in leading to rising debt distress. And many developing countries currently are in a very similar situation. So somewhat cynically, you may ask, what's new, right? How is this current situation different to the past? And one answer you can give to that question is, well, the identity of the lenders in this current crisis is different than in the past. Here I'm showing you another long-run graph from my work with Carmen Reinhardt and Christoph Krebesch, where we look at the long-run history in bilateral lending to developing countries. And you can see over this 120-year sample that throughout history, it's always been the major economic, political powers of their time that have been the key creditors to developing countries. So in the early 20th century, the United Kingdom, Western Europe dominated this market, followed by the US during the World Wars and in the aftermath. Soviet Union, OPEC countries during the 1970s played an important role, Japan. And now, since the turn of the century, it's really been China that has been providing a very large share of this credit and has become the world's largest creditor. Yes, please.
I just want to understand better what that stress means. Like, is it because I guess that there are different types of loans? There are the ones that are more associated with macroeconomic stability, but there are the ones that are more associated with investment with infrastructure. So I guess the motivation is different for those two.
So the stress here, they generally means countries that enter default, right? They stop repaying on their external creditors, or that restructure their debt in a way that is less favorable. That's the sort of big thing that we have. And here we focus on the flow, right? So this is the lending that these countries, that developing countries receive from different bilateral creditors.
But some of this lending is not necessarily because the country is going to default. It's just like.
No, this is just very generally bilateral lending, could be for infrastructure, could be general purpose lending, budget support. But with respect to China, right, primarily lending that has built large infrastructure and energy projects. That's here is completely independent of the defaults themselves, right?
I think you already answered. I was just want to clarify that this is bilateral official. So there are no private flows in this.
Not in this graph. Not in this graph. Although, of course, and it's very difficult to do this for private flows in a similar way, that the picture would look somewhat similar, right, over time, if you look at the share of the international private market of each of these economic blocks. So what I want to focus today, right, is this spike in Chinese lending that has occurred since around roughly 2000, has transformed China, as I said, into the largest state or official creditor to developing countries. And a good starting point, if you want to understand that boom, is to look at balance of payment statistics of the PBOC. This graph shows you outstanding claims by Chinese residents on the rest of the world from different debt instruments. And you can see that all the magnitudes are scaled by world GDP. And you can see that over the course of the past 20 years, from the turn of the century, these outstanding claims have climbed from more or less zero to around 6% of global GDP. So massive expansion in cross-border lending. And the largest part of this boom is driven by this blue area here, which is portfolio debt investment. So what this segment is that for almost 20 years, China had very large current account surpluses. It kept its exchange rate fixed, accumulated very large dollar reserves, and invested them in US treasuries. That was the key rise here in portfolio debt investment. But then around the time of the global financial crisis, interest rates in the US came down. This portfolio was earning very low returns, and the PBOC, China central bank, began to diversify its external assets. And what it did practically was that it took some of these US dollar reserves, it on-lent them to the country's state-owned banks, institutions such as China Development Bank or China Export-Import Banks, and tasked them to use these dollars, lend them abroad in order to earn higher returns. So at around 2008, you see the gray and the red area start to increase. These are trade credits to the rest of the world and bank loans to the rest of the world. And in this graph, it doesn't look very impressive, right? Because the blue area dominates the proportions here. But if you zoom in into the gray and red area specifically, you can see that over time of roughly 10 to 15 years, the extension of these cross-border loans by Chinese banks increased from, again, roughly zero to around 1.6 trillion USD, according to the country's balance of payments. So what was driving this boom? As I already said, part of the motivation was to recycle these large US dollar reserves and to earn higher returns on the country's external claims. And in doing so, there were other additional benefits for China, additional push factors, namely that these state-owned banks, they lend abroad to finance large infrastructure and energy projects, which then created demand for the services of Chinese state-owned enterprises. So there were a lot of synergies. And on top of that, and we'll see that in greater detail, these loans were also helping China secure access to foreign markets and to raw materials in developing countries. And sort of at the other side of the transactions, Chinese lending was welcomed with open arms because developing countries, capital-scarce developing countries, had very high demand for this sort of lending. They had and still have very high demand for infrastructure and energy projects. So these Chinese finance projects were highly attractive. And also at around the turn of the century, many developing countries had received debt relief from traditional creditors. So they had a lot of debt carrying capacity, a lot of fiscal space to borrow additional funding. So at the beginning of this boom, there were great synergies. There was a very mutually beneficial combination of push and pull factors. And indeed, for multiple years, Chinese lending was a really important source of economic growth in the recipient countries.
Just to get a sense of magnitude, so probably you're going to do it later. This is roughly the magnitude of the IMF lending or World Bank lend?
Much larger. We'll zoom in. This is somewhat rough, right? Because it captures everything that's recorded in China's balance and payments. But I'll get to measurements in basically. A key challenge of this boom, and I think getting to Cesar's question, is from the very onset there was a lot of secrecy in the lending process. As I said, the Chinese government treats overseas lending activities as a state secret. It doesn't publish any detailed statistics on outstanding overseas lending beyond these very accurate statistics. It was a major level problem that you see in balance of payment statistics that there were a lot of outflows, but it was a priori, it was entirely unclear who the account was. So as a consequence of this sort of boom, there emerged a whole academic literature that tried to track Chinese lending transactions. And like authors and myself, we worked a lot with the ADATA team at William & Mary, sort of built up an entire dedicated team that sort of focused specifically on tracking Chinese lending transactions. I don't want to go into too much detail, but just to give you a sense how this is done. If, for example, Chinese banks funds a major infrastructure project, Chinese government wouldn't publish detailed statistics on it, but that project would leave traces on the ground, right? So you could basically infer information from the annual reports of the contractors, maybe the banks themselves. There may be embassy statements. The press in these countries may cover some of it. So what researchers have typically done is to piece together all these bits and pieces of information and then sort of triangulate and try to verify that different sources give you the same picture, and then aggregate that from the bottom up and create data sets that try to capture as many of these lending transactions as possible. This was a question.
So it shows that the investment portfolio really parts the loans and the trade credits. So is this data gonna talk about any reallocation about the investment portfolio, or do you want, or are you gonna focus specifically on the loan part?
So sorry, by reallocation you mean?
Yeah, instead of US Treasuries, now all of a sudden you're buying, Treasury for like.
Yeah, so I think the reallocation is implied, right? Sort of by tracking an increasing amount of these loan transactions, you know that the increases in the treasuries are becoming flatter, but we're not trying to explicitly trace the portfolio and bond investments. And these researchers basically have created sort of project level, transaction level databases of these transactions, first in developing countries and now since they recently also in advanced countries. And you can take all of these transactions, these are thousands of loans that have been identified in that way. You can aggregate them up. You can try to estimate the outstanding debt stocks from the loans and sort of the much of our work, which is exactly what we have been doing. And sort of in the upcoming sort of slides, I want to draw from exactly these sort of data collection efforts. Yes, please.
Do you have a sense of whether or not China is replacing other capital providers, or is it meeting a demand that would not met otherwise?
So this it depends. So this boom that I mentioned, sort of this capital flow boom, what was larger than Chinese lending itself, right? The interest rates in global capital market were low. So there was a lot of search for yield, not just by Chinese banks, but also by, say, investors in the global bond market. Many sort of frontier markets in the developing world during that time managed to issue bonds for the first time in several decades. So it was a very complementary phenomenon. But then on the other side, some of the traditional creditors, Western countries, the US, countries in the Paris Club in Europe, they significantly declined their lending to developing countries after the debt relief initiative of the early 2000s. So there has really been a shift from loans to grants, so that Chinese corporations took up an increasing share in the debts of these countries. And you're going to see that in the next slides, actually. So to give you a sense of how this market has changed, and again, I'm focusing on bilateral creditors here. It's instructive to plot over time who is the largest bilateral creditor of developing and emerging market countries. So in the map, you can see in blue all countries as of 2000, where the largest bilateral creditor was a Western country. Western here is not used in a strictly geographic sense. It includes all member countries of the Paris Club, including Japan, South Korea. You can see for which countries China was the largest bilateral creditor in red, and for which countries it was an Arab country of the Gulf Cooperation Council in yellow. And if you now jump forward to 2021, you see that this map has changed very dramatically, right? So in around 60 to 70% of developing countries, as of now, China has become the largest bilateral creditor, replacing many of these Paris Club bilateral creditors that dominated this market for a very long time. And if you add up across country, if you add up the outstanding claims across countries, you can see that, coming to your questions, for a long time, for several years, Chinese outstanding claims to developing countries were not just larger than the claims of all Paris Club creditor governments combined, they were also larger than the entire portfolio of the World Bank and the lending portfolio of the IMF. So maybe to clarify, the Paris Club is a club that includes 22 different bilateral creditor countries, primarily from the West. So it's basically all of Europe, the US, Japan, Korea. And China, as a state creditor, is larger than the claims of all these 22 creditor countries combined. Yeah.
Can you just clarify, the debt to China is debt specifically to the Chinese government, or that includes like state-owned enterprises and banks?
No, very good point. It's important to clarify. So here, I'm referring to official creditors, and in the case of China, it basically includes all priority. Institutions like China Development Bank, China Export-Import Bank, but also the large commercial banks like Bank of China or ICBC.
I guess I'm just wondering if you're really putting China if you're treating China the same way that you're treating, say, the US or other Western countries, because you have the big banks there are state-owned, but they're also banks. And then
so that's true. Yeah, that's true. I mean, sort of depending. For China, these very sort of traditional labels, official, private, are very hard to apply, right? Because you have these hybrid creditors that on the one hand are state-owned and then using commercial lending models. That's in part, right, what has made these comparisons very difficult. I think sort of for an analytical perspective and to put the rise in perspective, I think it's interesting to see that sort of Chinese creditors as a whole have become a very important element of the market. Then when you turn to crisis resolution and you need to disentangle private and official creditors for, say, reasons of comparability of treatment, this is of course getting even more complicated, right? Because some Chinese creditors will identify as official while others will identify as private institutions.
Do you know to what extent this debt is internal, so that it's going from a state-owned agency to an affiliate of a state-owned agency, as opposed to going to external?
So here we are focusing entirely on lending that is provided to foreign residents, right? So this would be lending to, or to be even more precise, lending to public or publicly guaranteed recipients in the developing countries. So this is basically foreign sovereigns or foreign public sector recipients. They would exclude sort of subsidiaries of Chinese corporations abroad.
That's just considered private debt. That's the distinction you're making here.
No, that's public debt. So on the recipient side, it's entirely public recipients, say the central government or state-owned enterprises. And then on the creditor side, I'm focusing on official or state creditors. Let me say a few words on how China has extended these loans, right? Because some of the terms are really distinct. As I said, so China has exported its expertise in constructing road and constructing energy projects, but these banks have also exported to a certain extent their financing models that they pioneered in China. So here I'm going to draw from a study from back in 2023, when we, in a larger collaborative effort with lawyers and other economists, managed to identify, to collect 100 debt contracts that Chinese banks have signed with foreign governments, and basically analyze the entire documents to understand the financial and non-financial terms of these loans. I want to emphasize a few things, starting with the financial terms first. So first of all, if you think about the financial sort of interest rates of the lending, the majority of it, around 2/3, is commercial, right? That sort of adds to this difficulty in classifying these creditors. They are official or state-owned creditors, but they shouldn't be confused with official providers of development aid in the classic Western sense. So there's some sort of hybrid. Many of them have commercial business models. The second really interesting feature is that around 50% of these cross-border loans are collateralized, most often by the revenues from commodity exports in the recipient countries. I want to explain that in greater detail in a moment. And also, I think very interestingly is that around 2/3 of the lending has been denominated in US dollars. So that was, for us, that was very surprising at first, because we thought about these efforts also as part of a larger strategy to internationalize the renminbi. But again, the key motivation, right, was to recycle these large US dollar reserves. So it makes sense, I think, that around 70% of the outgoing lending is denominated in US dollars and comes sort of from this large bulk of US dollar liquidity that China had accumulated during the 2000s. Yeah.
So in terms of the use of collateral, is this fraction unusual? Like if you compare, if you were to look at like non-Chinese loans, would they have a larger fraction collateralized, a smaller fraction?
That's exactly my next point. I want to talk a bit about collateral, because it's very sort of, if you're working in this international sovereign debt literature, it's very surprising to see collateralized loans. At least for a very long time, we weren't aware, sort of as a researcher community, we weren't aware that a large share of this market used collateral at all. For example, if you open one of the foundational papers in this literature, Bulo Roga of 1989, they write, collateral is really important in the domestic market, but in the international sovereign debt markets, its use is negligible. And sort of, I would say, fair to say, for a very long time, there was a widely shared belief with investors, policymakers, and academics. And it was in part enshrined in practice through the lending practices of the international organizations, which typically include negative pledge clauses in their loans. The negative pledge clause simply tells the recipient that it is not allowed to pledge collateral to any other creditor. There was this thinking that collateral, well, so we knew of exceptions, we were not aware that collateral played an important role in international sovereign debt markets. So it's quite a surprise to see that 50% of Chinese international lending makes use of this. And also from the academic perspective, that the key friction in the international sovereign debt market is one of enforcement. So the idea is that there's no supranational authority that can enforce your cross-border claims. So if you can't enforce the repayment of the loan, how can you possibly enforce seizing any collateral, right? So it's not obvious how this should work. And in that context, I think I just want to walk you through very briefly in how a typical collateralized lending transactions between Chinese creditors and a developing country recipient looks like. It's a bit of an overwhelming craft, but I think it's easiest to understand if you first of all focus on the first row, which basically simply shows you credit transactions between a state-owned Chinese creditor, say China Development Bank, and a public recipient in a developing country, the Ecuadorian Ministry of Finance here. There's in this example, there's a $1 billion facility, and Ecuador, the Ministry of Finance, repays that to China Development Bank. Now, the specialty is that this loan facility is combined with an oil sales and purchase contract in which a Chinese state-owned enterprise and an Ecuadorian state-owned enterprise agree that the exporter, Petroecuador in this example, sells oil to an importer in China, but then rather than paying for these oil exports directly, the Chinese importer would transfer the oil payments into a receipts or escrow account that is situated abroad, typically in China, and very often with the creditor bank itself. So during the basically duration of this loan until it is fully repaid, China Development Bank may seize these proceeds in this escrow account and is able sort of to compensate any losses it may experience in the credit transaction with the finance.
Just a question here. So the way I had understood this was that the money gets borrowed by Ecuador, but it never leaves the Chinese bank. In fact, it often goes to a Chinese firm, which implements the project directly. So this line that looks like it's going here actually goes directly to the Chinese firm. It's just, it goes on the balance sheet up here, but the money never shows up.
Yeah, so I think you're absolutely right. So I'm not sure if that's always true, but that's a common variant of this transaction. Here's a bit simplified, right? Because we're just basically dispersing the dollars to the Ecuadorian Ministry of Finance. This graph doesn't show you how the money is used, but in practice, very often the case that sort of an additional contract is signed between a Chinese state-owned enterprise that implement the infrastructure project. And then it could indeed the case, as you say, that this loan is directly dispersed to that Chinese contractor.
Have you looked at whether or not these have the conditionality that they must hire Chinese firms? Because I've seen that in a lot of cases.
That's typically the case. So in the sample of 100 contracts that we studied, things of the typical transaction requires exactly that. So in most cases, there would be a commercial contract between a Chinese state-owned enterprise that builds a route and the recipient country first. And then after that, the loan contract would be signed, and somewhere in the loan contracts it says, well, the purpose of this loan is to finance that underlying commercial transaction. So typically these are webs of contracts that are sort of bundled together, right? And they involve several state-owned enterprises, typically on both sides of the transaction.
Doesn't that create a difficulty in trying to separate out what you're calling public lending and private lending? Because effectively it's blurring that line.
It absolutely is.
And so when you compare the flows, somehow it would seem to me that you'd want to look at the private lending flows going on from other sources as well, correct?
Correct. Yeah,
Okay.
correct. So I think that's I think you both a few comments, I think I agree with that. So it's very difficult to categorize these investors, right? Because they're combining elements sort of from the official state-owned universe of players with sort of more commercial business models and transactions.
Just please correct me if I'm wrong, jumping on Tom's comment. I think that it's many of the private lending that takes place from Western countries doesn't primarily go to some of these developing countries. They tend to go to emerging markets, which have much larger. So most of the loans that these countries are getting from the Belt and Road Project are official loans, whether it's from Western countries or from Chinese.
I would disagree with that.
You do?
Yeah. When you look at multinational activity and the way they finance their affiliates in developing countries, that's an important channel. And so
you're referring to private recipients now, right?
yeah, right. But effectively that boundary has been blurred here, right?
It is. I mean, I agree with that. So unfortunately, I didn't bring the table. We have a table in this latest paper where we compare sort of for different income groups, starting with the lowest income group, middle income group, upper middle income group, what the share is of sort of private Western or international bond markets and Chinese lending. And sort of, if you look at the poorest countries of the world, so say low income, 30, 40 countries, this is indeed more important than private lending, right? Because many of these countries do not have access to the international capital market. Then sort of if you move up the income groups and sort of middle income countries, upper middle income countries, market access in the international bond market becomes increasingly important.
So is there any angle that this is used for kind of barter trade to circumvent the maybe the US payment system? Is there any angle to this? Because what I can see is the money is in their account, but they are getting oil into their country through another form instead of having to go through the SWIFT payment system.
Yeah. So I think you're absolutely right? It has sort of a barter character. I think originally these arrangements have not been made with the intention to circumvent sort of SWIFT infrastructure. Although now, very recently, we have seen similar transactions emerge in countries like Iran. And I think there, you may argue that exactly that is one of the key motivations, although
Sanctions, so.
could be right. Yeah. So for example, Russia has been repaying its lending from China through actual oil deliveries, which follow deal structures that are quite similar. We've seen that emerge also in countries like Sudan or Iran, where I think sort of this could be a major incentive. Yeah.
So I'm curious what kind of access to these escrow accounts the borrowing country actually has. Because China can presumably remove access. That's sort of the whole point of the overseas collateral. It seems as if what differentiates payments into the escrow from just debt payments would presumably be that the country has some access to them as long as they make the debt payments. What's the sort of structure
So
of what the country can access and what they can't access from the
There's
escrow?
really an account management agreement, right? That sort of describes and governs exactly how much access the exporter in that case has on the accounts. And so these could come in very different forms, and sort of it's very hard to see for a typical transaction what's exactly in there. What we have seen in the small sample we have studied is that typically this receipt account would have some sort of minimum account balance requirement that tells you that there always needs to be, for example, debt service payments equivalent to the next 2 or 3 installments in the account. Right? So while the entire proceeds are routed through the account, the exporter could access a certain share of that, but then for there to be further disbursements or for the loan to not be in default, it always needs to retain this minimum balance. We also see deals in which sort of additional sources of collateral are connected to receipts accounts. So if one source may fall short, there may be other source that can be used to replenish the account. But in general, it's very hard to sort of see, right, what the specifics of these transactions are.
I'm wondering from what I understand, you're going to take something like this is going to count as $1 billion lent by China. I guess I'm wondering, is that the right way to value the debt? Because really what China's doing is it's saying, we'll build a bridge for you and you'll give us some stream of payments. And it's not obvious why that has to actually be worth $1 billion.
Yeah. Well, I think what you were pointing at is a very general problem, right, in the construction of that statistic. So we're, I think, used to this convention that we report debt at nominal values. But there's a literature out there that sort of argues there may be, for example, net present value approaches that may do a much better job in reflecting the true liabilities of the country. So I agree with you, right? Sort of what is the real burden of such a transaction? You could play around with all of these parameters and come to different conclusions. That I think is not entirely China specific, I would say. Yeah.
Look at the relationship in this example between China and Ecuador. Are those contracts, is that usually like a fixed price? Is it a fixed amount of oil China's going to buy? And do the terms of those contracts match as far as duration, match the term of the loan facility, or are they usually longer or shorter? Could you go into that?
Yeah, that's an excellent question and one we have been trying to answer for a very long time. This is another contract, right, that is typically not publicly available, so it's hard to understand what exactly is in there. A key question, if you want to understand how attractive is such a loan, is how much is the price that the Chinese importer pays for the barrel of oil. And I think there are different contracts on which sort of China may be buying at a discount. There may be even a fixed price so that the importer, if the price developments are favorable, might earn a premium. In most cases, it's really a complete black box. But it's interesting, I think also relates to the other question here. It's very hard in practice to evaluate the desirability of such an agreement because in all of these different contracts, there are different parameters. We may know the interest rate and the maturity of the entire thing, but it's very hard to know how much is the country paying for the infrastructure project. Is that a fair price or not? How are they valuing commodity exports? Is that a market price or not? There's a lot in there that is typically not visible for outside observers. I mean, just maybe to put it a bit into perspective, you can look at it. So clearly, China here is a muscular creditor that writes credit-friendly contracts, but you can look at this in two entirely different ways, right? There's a very benign interpretation here that sort of comes again from the sovereign debt literature that emphasizes the role of frictions in cross-border capitals. You could say that, well, the key problem in sovereign debt markets is that you can't enforce debt contracts. And Chinese creditors are now writing contracts that are innovative, that include so-called, or include something akin to sticks, that make default less attractive. And that helps everybody, right? And in particular, helps the recipient countries that may not be able to attract funding from the international capital market without such arrangements. So if you think, for example, about this famous paper by Robert Lucas from 1990, where he asks, why is so little capital flowing into developing countries? Has to do with institutional quality, has to do with frictions in enforcement. This may be a way to ensure that creditors are able to lend into capital scarce economies where these funds have particularly high returns. And if you think back sort of this world map, China has indeed been lending to some of the riskiest, most unstable countries in the world. So from that perspective, these arrangements may be a prerequisite and maybe in the interest of the recipient country. A less benign interpretation sort of focus on the externality that these arrangements may have for other creditors. You could argue that in the sense of that dilution theories, right? China is sort of moving to the front of the repayment queue, and if other creditors become aware that the country is promising collateral to China, they may also either try to get collateral from the country or they may try to charge higher interest rates to be compensated for the perceived or actual subordination in the repayment chain. And then if default does indeed happen, right, collateral may be detrimental because it rids the recipient countries of this option value. In an uncollateralized transaction, I mean, you can always walk away. There are costs of default, but you always have this option to just not repay. Here, this might be very difficult if your creditor has access to a significant part of your commodity revenue. So you lose that option value, and that may make defaults, if they happen, more costly than they would otherwise. Let me introduce one other feature of these contracts that I think is very interesting and sort of very important to understand also the debt sustainability implications of China's lending. In the sample that we study, we find very broad confidentiality clauses. Here's an example from a contract with China Export-Import Bank, where it says the borrowing country needs to keep all terms, conditions, and the standard of fees here under or in connection with this agreement strictly confidential. So without the prior written consent of the lender, the borrower shall not disclose any information. So that's a very broad confidentiality clauses. Now, confidentiality clauses in bank contracts are not uncommon, but typically if you engage in a lending transaction with the bank, the confidentiality clause would bind the bank, right? So that's a typical banking secrecy. The bank is not allowed to disclose information about the debtor. And here this is turned around in the way that the debtor is not allowed, at least if you follow the contract terms, to share information under contract. So these confidentiality clauses and other parts of the lending arrangements have given rise to debates on how well the recipient country debt statistics capture these lending transactions. And there's more to it. So for a long time, at both the debtor and the creditor side, there were several factors that made it very unclear whether sort of we had a good sense of how much credit is flowing. And I already mentioned several of them. So at the debtor side, much of Chinese lending has been going to countries with weak institutional strengths, with low debt management capacity, and we've known for a very long time that sort of these countries are prone to underreporting of their debts. At the same time, a large share of the lending has been directed not to the central government, but to special purpose vehicles or state-owned enterprises in the recipient countries. And again, these are sort of notorious for not accurately or comprehensively reporting their liabilities. These are not specific to Chinese lending, right? A lot of that goes missing, and sort of the elements at the debtor side, that doesn't really matter whether the creditor is from China or from another country. They are prone to unreported debt. But then these are amplified in China's case by factors specific to the creditor. For example, the fact, as I mentioned, that China is not a member of these typical multilateral arrangements where data is shared, which is the OECD or the Paris Club. it has been systematically using these confidentiality clauses, and it has not released, as I said initially, sort of detailed creditor statistics on its overseas lending. So in one of our papers, we do a very simple accounting exercise and ask how many of these transactions that are identified by 8data and others, what share of them has been correctly reported by the developing countries to the World Bank that uses the debtor reporting to publish international debt statistics. And what we find in this exercise is that at the height of the lending boom, that was as of 2019, around 50% of the lending had not been reported to the World Bank, so that the outstanding debt stocks that these countries publish were significantly underestimating the true liability. I think that was in part, it was one of the reasons for why during these boom years, there was a lot of over-optimism, simply because some of the statistics, at least in some countries, did not provide an accurate picture of how fast liabilities were rising. And then very interestingly, during the COVID pandemic, when many of these recipient countries turned to the IMF programs were taking place, countries were experiencing debt distress, and there was suddenly a lot of scrutiny on how accurate these debt statistics were. We were seeing very large ex post upward revisions of the debt statistics to China, but also to other creditors. So this graph shows you in IDSs, the international debt statistics of the World Bank, for 5 different editions or vintages of these statistics, how much lending to official or private creditors was added ex post, right? So to previous years. And there were massive upward revisions, as I show in a paper with Cesar, that led to the debt stocks of many developing countries increase in hindsight. So this graph shows you the ex post upward revisions of the 2016 external public and publicly guaranteed debt stock within the pandemic. So to give an example, in the edition of 2018 from this debt statistics, Tanzania's external debt stock was in 2016 was believed to be $9.8 billion. But then a couple of years later, if you downloaded the same statistics for the exact same year, it suddenly said that Tanzania, as of 2016, had $11.8 billion in external debt. So an upward revision in hindsight of $2 billion, or more than 60% of the initially reported debt stock. We do that very systematically in the paper with Cesar. This graph basically captures previously unreported debts with both China and other creditors, and you can see that this initial underreporting really contributed to a spike in debt during the pandemic. So only once the lending boom was coming to an end, international observers realized how strongly indebted these countries truly were. And that sort of is another feature that is very present in past boom bust cycles as well. In the paper with Cesar, we study this in not just the current debt crisis, but also the 1980s and the 1930s. And again, the debts are higher than initially thought once countries enter distress.
So due to this non-disclosure clauses, does it harm this country from taking on debt from, suppose, from the World Bank, because they are not able to disclose the debt they already have through the Chinese firms or Chinese banks?
That's a very interesting question, right? So when we study these debt contracts, we see a lot of clauses that seem inconsistent with the contracts of other creditors. I gave the example of the negative pledge clause, right? The World Bank contract would tell you you're not allowed to pledge collateral to any other creditor, and then you sign a collateral lending contract. It seems to be that sort of this was not an obstacle to signing these multiple contracts, despite the existence of these discrepancies. And it's not entirely clear to me why sort of these discrepancies could exist for such a long time. I think in part it has to do that the international organizations didn't actually enforce the requirements they had in their contract. I mean,
also the second part to this question. So like when suppose a World Bank lends to someone who has already had Chinese debt, then they see that they have this debt, so the riskiness of their investment or the lending increases. Do they then tweak the terms to have a higher interest rate because now it's a riskier investment or debt?
And that's a very interesting hypothesis. We haven't tested that formally, right? It's very difficult. I mean, an interesting question is, and an important concern is that other creditors, that's what I was alluding to with the dilution story, is that other creditors will price in the risk of being subordinated in these countries. And that empirically is very hard to do. I don't have very solid evidence to sort of point you to this phenomenon. But it's been a key concern that these clauses trigger exactly these sort of dynamics where at the end of the day, and in equilibrium, the recipient countries get harsher and harsher terms, right? Because everyone needs to be compensated for the actual or perceived threat of another creditor asking for harsher terms.
But at least in terms of case studies, this kind of hidden debt is often delays things like IMF negotiations.
True, yeah.
So Pakistan in 2018, 2019 took a very long time to get an IMF loan because the IMF was saying, you have to tell us how much you owe China.
True, yeah. I mean, that is indeed something. Yeah, that is indeed something that we're showing empirically in the paper with CSR, right? Where we have sort of these long run time series, and then we can basically link the amount of hidden debt, and we know that sort of in hindsight to outcomes such as the length of a debt restructuring episode. And just like you say, it's taken particularly long for countries with high hidden debts to restructure a debt with external credit. It's also the story of Zambia, for example, right? Where this trust and the lack of transparency just extended this very painful process of restructuring debt.
So, one thing that, as somebody who works on China is full of hidden debt, right?
Mhm.
I mean, the localities are overladen with hidden debt. So I guess, maybe you said this and I missed it, but what percentage of the hidden debt is from China? Do we know that? And then there's this big question in Washington, is there a debt trap? Is there not a debt trap? It would seem if there's a lot of hidden debt, that would lean towards there may be some nefarious activity going on. But I'm not saying it is, but I'm curious your view of it.
Yeah. No, so the first point, very interesting, right? I think that's exactly what I meant when I said, well, these countries China didn't just export sort of the expertise in constructing roads, it also exported this very specific financing model that has created very similar problems in China itself. Now, what share of the hidden debt is from China? That's very hard to answer, right? Because typically the statistics that we exploit in such a way do not include bilateral breakdowns. So it's very hard to disentangle what share of these stocks was indeed hidden debt from China versus other creditors. You can do it in confidential statistics, but we're not allowed to sort of publish it.
It does match up nicely with the increase in Chinese lending.
It does. Yeah, it does. Also, if you look at the list of countries, I mean, many of these are top recipients of Chinese borrowing. So that was indeed a large part of that boom. I don't think it inevitably implies sort of malign intentions because, as I said, right, hidden debt is very complex. It has to do with issues on the debtor side, weak institutions, and with issues on the creditor side, the confidentiality clauses and the lack of creditor statistics. So this entangling sort of what share of hidden debt is causally driven by sort of Chinese decisions, whereas it's causally driven by recipient country decisions is very, very hard to do. You would need sort of some sort of experiment, right? But sort of statistically speaking, I mean, Chinese lending obviously played an important role in driving this pattern that we see here.
Is there a reason why Russia is missing from that list?
Russia is a special case. So the drawback of this approach of studying ex post upward revisions is that you'll only find hidden debt if the country at some point gets clean, right? And publishes hidden debt. So it's a lower bound of true hidden debt. There are countries that underreport and never reveal the true indebtedness. And Russia is one of these cases. Indeed, Russia was in the World Bank International Debt Statistics for a long time. It was a pretty obvious underreporter. And in 2022, it was excluded from these statistics altogether. There was never an upward revision in the Russian statistics. So we have no way of inferring how much may have been missing. So in the final part, let me turn to the ongoing debt distress in many of these countries. One way to see this is to look at the average sovereign risk rating of China's overseas lending portfolio. This is an average that is weighted by the outstanding claims, and you can see that over the course of the past 15 years, it has been trending downward gradually and then more radically over the course of the past couple of years. And this in part has been driven, as I said in the beginning, by these global shocks, by this reversal of these initially very benign global conditions. You had a commodity price bust in around 2015. You had a default in Venezuela, which was very important because that was a very, very large recipient of Chinese lending. You had the COVID pandemic. And then most influential in 2022, you had the war in Ukraine that hit the Chinese portfolio very hard because roughly 20% of its overseas lending had gone to Russia, Ukraine, and Belarus. So in part, right, this is driven by global factors that affected all creditors alike. China was particularly hard hit because its lending had specialized in high-risk countries. So China has been allocated a particularly large share of the portfolio to countries like Venezuela, to Pakistan, to Zambia, and so on, to Russia. So its curve, basically, its average rating was hit harder than the average rating sort of a benchmark portfolio.
I mean, there's a big drop in it for the war in Ukraine there. Another thing that was happening at that time, though, was we were seeing significant rate rises in the US and other developed countries as well. And that also leads to a big retrenchment of capital flows from emerging markets.
Absolutely right.
Do you have a sense of how much was driven by the actual war or how much was just driven by
Sort of for this,
all the capital went back to the US and a lot of countries were now struggling.
so for this immediate sort of downgrade, that can be very, very easily attributed to it, right? So there was this very sudden reaction of rating agencies and we're responding to the war in downgrading Ukraine, Russia, and Belarus. And that's, as I said, 20% of the portfolios of China was hit very hard by that. The reversal of US monetary policy is more part of the gradual decline in the portfolio. So how has China responded to the stress? Sorry, the question.
Are you able to decompose that into a change in the type of country that China's lending to versus shocks to?
So it shows that. So this is a balanced panel. So we only include countries here that are basically, we have rating observations over the entire period, but we do not control here for rebalancing over time. But sort of the overall pattern is very, very similar. You could keep the weights fixed and then you'd get a very similar picture, at least in the last one. So one response by Chinese creditors is that they have curtailed new lending to developing countries in a very radical fashion in around 2019, almost akin to what for private creditors we would call a sudden stop. So in this graph, you see net transfers. That is the difference between new lending and repayments of interest and principal to Chinese banks. And you can see right during the boom years, there were very sizable transfers to developing countries. And now for the past 5 years, this has turned negative, meaning that developing countries as a whole repay more to China than they receive in new lending. So if you want to summarize the boom-bust pattern in one picture, I think that would be it, right? So sort of lending was very high, net flows were very high as long as global conditions were benign, and they reverted around 2019 in a very pro-cyclical fashion, just as we have seen in many past lending booms with private creditors. And then another interesting parallel is in those countries where debt distress has gone up. Chinese creditors have also reacted in ways that they're highly reminiscent of what Western creditors have done in the past. Usually the Chinese reaction to debt distress in developing and emerging market countries is a combination of rescue lending, so provision of new liquidity in those countries where Chinese creditors are highly exposed, and then debt restructurings, in particular in low-income countries where the stakes are somewhat lower, right? But the commonality of both approaches is that for the most part, they're providing just a little bit of additional liquidity relief, whereas not restructuring or not addressing underlying solvency issues. The restructuring, and we'll see that in greater detail, typically involved a small maturity or grace period extension, whereas we haven't really seen major reductions in the outstanding principal amounts, and we have rarely seen reductions in interest rates. So typically, this is a form of fairly short-term liquidity relief that leaves the outstanding debt stock constant. And as I said, very interestingly to us, so despite these differences in the lending model, this approach to debt distress for Chinese creditors has been very similar to how private creditors have reacted to debt crises in the past. It seems to be in the initial stages of the crisis, there always seems to be this temptation to treat the problems as temporary liquidity problems. You want to give the debtor a little bit of additional breathing space without realizing any sort of nominal losses on your own balance sheet. It's also very much reminiscent to what we saw in the Eurozone crisis, and was that context has always been characterized as this kicking the can down the road approach. So you gain a little bit of time by providing limited relief.
Quick question: is there any variation in the the distress debt based on whether they were hidden or not hidden?
Sorry, I didn't.
Is there any difference between the hidden debt and then the unhidden debt in terms of how likely they face the distress, down the line?
Unfortunately, we do not know because it's very hard to, in order to test it, you would need to observe both basically the hiding and the restructuring at the loan level. And for most countries, we do not do that. So we only see sort of at a more aggregate level which countries restructure in what years, whereas it's very hard to sort of compare the propensity of an initially hidden obligation with an initially reported obligation. Fortunately, we cannot do this. Although in our work, sort of one prior is that if a liability is indeed unreported and stays unreported, we'd expect that to not be restructured, at least not in the context of a major multilateral agreement, right? So things that are not on the books are probably likely to go unrestructured.
I'm remembering a story of China seizing a port because of debt. Is some of this willingness to restructure an effort to avoid those headlines? That might be speculation, sorry.
Yeah, so the Sri Lanka case has made a lot of headlines, right? So it's still to this day, I think it's very much contested what really happened in that case. And there are a lot of scholars that really disagree with this interpretation that this was a seizure of an asset in response to that distress. So empirically, this is not something that we observe systematically in these countries. I mean, what really matters is the existence of this cash collateral that I mentioned. And that, of course, right, could be a substitute for restructuring. If you can access cash in these accounts, you may not need to restructure in the first place. So interestingly, despite the existence of the collateral, Chinese creditors have actually restructured quite a lot. You can see that here in this graph where we plot the frequency of debt restructurings with private external creditors in black, so with bondholders and banks, and the frequency of restructurings with Chinese creditors in red. And you can see that sort of still, for a large part, the restructurings were almost entirely carried out with private external creditors, but then in recent years, restructurings with Chinese creditors have become a really important, in the sense of a very frequent phenomenon in this market. And an interesting question is, right, so that this just gives you the frequency. What do these restructuring agreements entail? I already said, so they tend to be very shallow. They tend to focus on liquidity relief. And in an ongoing project, we're studying that in greater detail.
Just going back to this, I know that there may not be an answer to this right now just because of transparency and data limitations, but do we know of any instances where that overseas cash collateral was seized by China in specific instances?
Yeah. So indeed, it's very hard to observe that, right? Because you do not really see the movements that are happening on these accounts.
Yeah.
There are one or two anecdotal evidences where you can actually observe through some sort of books and some glimpses of what the amount on these accounts were, and you see that they drop in certain instances, which sort of may suggest that it was in the context of that distress, which may suggest that the creditor did indeed seize the liquidity on these accounts. But in general, sort of this, and it's part of the issue, right? If you think of creditor dilution, it's very hard for researchers, for surveillance teams of the IMF or the World Bank and for other creditors to observe whether Chinese creditors are making use of these accounts or not. We don't really know whether these arrangements are effective, right? There's, of course, reason to fear if you are another creditor that they may be, right? Maybe just as my final point, right? For these Chinese restructurings that we identify in ongoing work, we estimate the haircuts. So a haircut in this market is typically understood to be the net present value reduction that the creditor suffers in an exchange of debt instruments. So debt restructuring basically means that you give up the existing liability, you get a new liability, and typically that has somewhat less favorable terms for the creditor. And one way to quantify these effects, for example, from longer maturities, from lower interest rates, is by estimating the so-called haircut, which is simply the change in the net present value of the old and the new debt instrument. We can do that for some Chinese creditors, and so this graph shows you the ongoing work that we are doing. The size of the cycle reflects the amount of debt that is restructured in constant US dollar, whereas on the vertical axis, you have the haircut in percent. And you can see that the mean haircut for the Chinese debt restructurings we could identify and for which we could calculate the haircut has been 14%. So the average creditor loss in net present value terms of these deals is 14%, which is very low in historical comparison to private creditors, where the average haircut has been 37%. And you can see that in this graph that now combines these estimated haircuts for Chinese creditors in red with the estimated haircuts for private creditors in black. And you can see sort of what I just said, right? The average for the Chinese creditors over the past 50 years is significantly lower than the average for the private creditors. But then again, if you compare the picture here to the 1980s debt crisis, you also see that maybe the losses that Chinese creditors have suffered are just the beginning of sort of a much longer debt resolution cycle. If you look at the 1980s debt crisis and the haircuts experienced by private creditors, you could see that it started out from very low levels as well. And then over time, the restructuring practice evolved from these tiny provisions of additional liquidity towards much more profound, much more painful restructurings, where the private creditors actually lost pretty sizable shares of their outstanding claims. And it's well perceivable, sort of, if this history is any guide, that Chinese lending will suffer a similar fate. And so one suggestive data point is this fairly recent restructuring in Zambia, where Chinese creditors for the first time experienced a pretty profound haircut of roughly 55%. So Chinese creditors may be a bit speculative at the beginning of a longer debt resolution cycle, where they'll eventually also need to suffer larger losses as did private creditors in the past.
But because they have these collateral loans.
Yeah.
So if you have all this money out to Angola and Venezuela, you can each barrel of oil. So do you even have to take a haircut, or just slowly recouping one barrel at a time?
Exactly right. We don't know. We don't know. So we see restructurings in countries with and without collateral. But it may well be the case, so I said, it's a bit speculative, right? It may well be the case that we'll see frequent restructurings, but very little relief, and sort of in the background, they're being repaid in a fairly silent fashion because they have access to all these credit enhancements. That's also a very plausible scenario, and so at this stage of the bust, I don't think we can give a definite answer to that. I'll wrap up here, a short conclusion summary. So what we find very fascinating is that this Chinese lending boom, despite all these distinct characteristics of Chinese creditors, has evolved in a way that is highly reminiscent of past capital flow boom and busts, in particular to the one in the 1980s. So far, so if you think about the consequences for the different players, for China, the losses so far have been fairly small. Larger losses may or may not lie in store. For the debtors, the net effects, I think, are very uncertain. They received a lot of infrastructure, large roads, large energy projects. At the same time, many of them are now having to make very large debt service payments or experience the very different, very diverse costs of default. So the net effect, I think, is very much unclear at this point. And then interestingly, so for the more broader picture, for the international financial architecture at large, I think what we are observing in China is just one element of a broader shift, is that the international financial architecture in many ways is evolving into something more opaque, more fragmented, and also more multipolar than we experienced in the past. And I'll stop there, and we're happy to discuss further.
You can go ahead and collect questions, or
yes, please.
Yeah, thanks for the talk. So the question I have is, I guess the comparison you're making here is with Western, mostly multilateral lending institutions. The kind of, as you acknowledge, it's not quite an apples to apples comparison. How much are you looking at the practices of China's lenders in comparison with those other East Asian countries, so Japan, South Korea? Because China has borrowed a lot of development from those playbooks, and how much do we see, especially when there's this combination of lending with foreign investment, a similar technique?
Yeah, that's a very good point. We're comparing the Japanese lenders in the sense that they're also part of the Paris Club.
Yeah.
But then even within that group, right, there's a lot of heterogeneity. We have some sort of anecdotal evidence that Japan in the 1980s and 1990s also experimented with collateral techniques. Mm-hmm. But to sort of our knowledge, none of the use of collateral, for example, or confidentiality has never been as systematic as we now observe in China's case. So I think even when comparing within that sort of more narrow group, the basic results stand.
Yeah.
But I think it's definitely true that there have been the picking elements here and there and have sort of taken different lending models on board and then developed that into something more potent, more innovative.
Yeah, thanks.
Thanks for the presentation. Was super interesting. I guess my question has to do with, it seems to me that there are two different stories in your presentation. One is that Chinese lending has this very different thing, which is the collateral arrangements. Then there is this other part towards the end that in which you are saying, actually, we don't know if this is going to be that different from other right? So I guess a question that you have alluded a couple of times is, it's unavoidable to some extent, and I would like to hear your thoughts about it, is to what extent do you think that these arrangements are effective?
Yeah.
I could imagine that they could be effective to prevent kind of rogue governments, but then are ineffective to prevent the structural crisis, that is when real default happens. So I don't know. What's your sense of it?
Yeah, no, you're absolutely right. I mean, that's sort of some contradiction we observe, right? You have all these new features, and then again, what has been playing out, at least at first glance, seems fairly similar to what we have seen in the past. My sense is that sort of these arrangements are collateral. These arrangements are effective. For example, collateral in the sense that they give China discretion to make decisions, give China bargaining power. Right? They are sitting in the driver's seat in these negotiations, and they can say, "Are we willing to provide the government with leeway? Are we willing to restructure? Or are we just playing sort of hardball and sort of just waiting and trying to get service through collateral payment?" I think this has been shifting. No matter how basically all of this turns out, I think it has been shifting leverage and negotiation power to the creditor. I think in that sense, it's effective, right? Because it gives the creditor the ability to decide, do I want to use that for political advantage? Do I want to use that for strictly financial advantage? So I think that may be the key advantage they have gained.
I'm still very curious about these escrow accounts. One of the things that you might, because the account's located in China and fundamentally overseen by a Chinese bank, you could imagine it being used for potentially other reasons. I mean, take for example, maybe there's an election or something in that country, and you have one politician who's not super fond of the Belt and Road Initiative. Is there implicitly sometimes a threat that, like, hey, if you change the regime here, half of your escrow accounts can disappear? I mean, that's not under the original contract, but it's also, all the money's in China now. So in some sense, China has complete control over that. And do we see any of it? I don't know. I'm curious to see. It introduces a lot of interesting incentives that are not even strictly.
So I do not have a specific case I can point to, but I think my answer will be very similar to the one just gave. It's very hard to observe how the contracts and how the negotiation power that the creditor gains may be used in practice, right? And what you're suggesting is could definitely be part of the picture, that you just use this negotiation power to then put pressure on the recipient government, be it for economic or political reasons.
I mean,
right?
the administration did something kind of like this with Argentina. Well, if Milei gets elected, there may be some money flowing your way. I mean, this would be
exactly.
You could imagine similar sorts of things going.
To be fair, right, official lending, I think official finance has always been used to a certain extent in that way. So it would be surprising if it was different in China's case. But then sort of showing that empirically is, of course, very hard, right? Because much of this would probably take place in very informal negotiations, communications, which we do not observe.
Sebastian, actually an anecdote on that.
Oh yeah, sure.
So I was in Beijing, I was at the Kapinski Hotel, I was coming down in the elevator, happened to be during the Belt and Road Forum. I'm standing there as a Pakistani guy in the elevator. I said, "How you doing?" He said, "How you doing?" So, "What are you doing here?" He said, "I'm the advisor on Belt and Road to the Pakistani Prime Minister who's staying up on the 7th floor." I said, "Great, you want to have breakfast?" "Yeah." So we had breakfast, and during the breakfast, he said to me that they didn't originally want to come to that meeting at all, the Belt and Road Forum, but they needed the disbursement of a loan for a railway project or a highway project that they wanted, that was supposed to come but hadn't come. And so the Chinese said to them, "You want your money? You're going to come, and you're going to come to the forum, and you're going to, have some roast beef with us or whatever, and then you'll get your money." So there was a political leverage there
Yeah.
on the Pakistani side, which was like, we're gonna come, but only if we get our money. And the Chinese like, you better come if you want your money.
Yeah.
So it was, but again, very anecdotal.
Yeah.
I happened to be there at that moment and hear that story. Hard to trace this to ground and
Yeah.
find out how much,
Yeah.
how extensive it is.
Just for like additional context here, I mean, like, China wouldn't have to rely on this particular instrument, right? Like, this could be one of a large range of instruments that it could use, to dangle incentives or costs in this way. But it's like all of China's diplomacy routinely deals in sort of implicit or explicit threats of offering or retracting investment or other economic benefits or trade access. So this is like, it could be seen as a tool, but I wouldn't see this as like some kind of magic weapon that it uses on, that has special effect in that way.
I mean, it's a much lower cost instrument to enforce than anything else is one thing. I mean, at least with the Trump administration and the grant, you have to fund that somehow. You have to deliver the promise. Here is just sitting in a box on your shores and you can just kind of grab it whenever you want.
But I don't know that the specific example you gave where you say, if you want your money, you'll vote for, like we did with Malay.
Yeah.
I've never heard of anything quite like that.
Yeah, sure,
It's,
yeah. Yeah.
All right, I think I need to thank again Sebastian. Thanks a lot to everyone who showed up. And I think after this, we can ask whether that breakfast was paid by Kellogg or not. Thanks a lot.